This is a financial statement analysis of Universal Robina Corporation for the years 2015 to 2019. Universal Robina Corporation, or URC, founded by Mr. John Gokongwei Jr. in 1954, is one of the largest branded consumer food and beverage product companies in the Philippines, with several production sites across Pan-ASEAN countries and continuously growing outside these territories with its recent expansion in New Zealand and Australia. The most known brands of URC are Jack and Jill for snacks, C2 for ready-to-drink tea, and Great Taste for coffee. Before we dig deeper, let us first define what is financial statement analysis. Doing good with accounting results as reflected in the financial statements can help the company improve its stock price and attract investors and convince lenders of the firm's ability to pay its short-term and long-term liabilities. Thus, companies and the users of their financial statements use financial statement analysis to evaluate their financial results in terms of liquidity, asset management, financial riskiness, and of course, profitability. We will start off with assessing URC's ability to pay off debts that are maturing within the year through its liquidity ratios, the current ratio and a quick ratio. Current ratios indicate the extent to which current liabilities are covered by current asset and is computed by dividing current assets by its current liabilities. Quick ratios, on the other hand, is just almost the same as current ratio, except that it removes prepaid expenses and inventories from the current assets to convert it to quick assets, as the two are not easily convertible to cash. For the analysis, as observed, the company is doing well with its current ratios, and it is even going up, differing by 80 points with the industry average. This is primarily brought by its increase in working capital assets, most especially cash, inventories, and receivables, without significant increase in current liabilities. However, since almost half of its current asset is inventories, increase in inventories decreased its quick ratio. In conclusion, the company has the ability to pay its currently maturing obligation. For the asset management ratios, here we would like to assess the company's ability to efficiently utilize its resources by converting them into sales. First, we have the asset turnover. This measures how many times URC converts its asset into sales and is computed by dividing sales by the total assets. Meanwhile, inventory turnover ratio tells us how many times the inventory was turned over into sales using cost of sales, since inventories are measured at cost while sales are at selling price. For the analysis, as you can see, asset turnover ratio of URC is decreasing. Over a 5-year time, assets of URC increased by almost 60 billion, while its sales increased only by 25 billion. The reason is actually preliminarily discussed in the liquidity ratios and further supported by the inventory turnover. Cost of sales increased only by 28%, while inventory increased by 52%. This might be brought upon by its expansion. However, URC must take into consideration lowering its inventories, especially its raw materials, by adopting inventory management techniques and better supplier relationship management. This does not only negatively impact their efficiency and liquidity ratios, but this also brings in additional holding costs which might also affect their profitability. In addition, cash freed from doing better with inventories can be used to pay for liabilities. In conclusion, URC is just as good as other in managing assets, but falls short when it comes to inventory turnover. For the debt management ratios, we will be evaluating the company's effectiveness in managing its ability to leverage. First, we have the debt ratio. This tells us the extent to which assets are financed by debts. This is computed by dividing total debt by the total assets. Next, we have the times interest earned. This ratio measures the firm's ability to pay its finance charges by earning more than that through its operation. This is computed by dividing earnings before interest and taxes by their interest expense. For the analysis, based on these ratios, the company's debt is well maintained below 30%, while the industry is at 40%. This may mean two things. On the bad side, that URC is not taking full advantage of its leveraging capacity. Or on the good side, it wants to lessen its financial risk by keeping it at that level. However, despite the efforts to keep debt at this level, its earnings before interest and taxes is not keeping up despite the increase in sales, as operating cost percentage increase exceeds the percentage increase of sales. For the conclusion, despite having less financial risk than competitors, URC has less margin of safety in terms of ability to cover interest expense with the profitability of its operation. Now let's proceed to the final set of ratios that we will be discussing in relation to URC, the profitability ratios. These ratios measure the company's ability to provide return to its investors and show the combined effects of its liquidity, efficiency, and debt management. First on the list, we have operating margin. This ratio provides the percentage of sales that is able to cover interest, taxes, and return to its stockholders. This is computed by dividing earnings before interest and taxes over sales. Next, we have the profit margin. Compared to operating margin, this is the net income per dollar sales, meaning interest and taxes are deducted already. This further means that profit margin is the percentage of sales which will go to the equity holders. We also have return on assets and common equity. Return on asset is a percentage of assets converted into income. This is computed by dividing net income by total assets. Return on equity, on the other hand, is one of the most important ratios for an existing and prospective investor, as this shows the rate of return on common stockholders' investment in accounting perspective. Last but not the least is the earnings per share, or the EPS, also called the bottom line, calculates how much each stockholder earned from the company's operation. Unlike ROE, which measures profitability as to the amount of the invested capital of stockholders, EPS bases the profitability on the number of stock the company's stockholders hold. For the analysis, as the company's margin, we can see that the company falls far below the industry average, and this is because its cost is eating big chunk of its sales. As discussed previously, its percentage increase in cost is greater than its percentage increase in sales, resulting to decreasing margins. Worse, this is despite the fact that URC is not using as much debt as other industries and therefore is expected to have lower interest expense and higher margin than others. This also affected its return on assets and equity ratios, as its assets and common equity both increased while its net income decreased. However, looking at its EPS, it is actually securing income to each stockholder better than other companies. This might be due to the lesser number of shares issued by the company compared to others. In conclusion, though the company is providing greater income per common stock than others, the company can improve further its profitability by finding ways to lower its cost of operations and/or by decreasing its assets. For our overall conclusion, the company is highly liquid and solvent but must improve when it comes to efficiency and profitability. To do this, we recommend first, URC should hold lesser inventories, especially raw materials. Second, more efficient collection policy to lessen accounts receivables. Third, increase use of debt to about 35%. Fourth, use cash freed and obtained from less working capital and increase in debt to repurchase stocks or support its expansion outside the Pan-ASEAN countries. And lastly, strive for more efficient operations and eliminate non-value adding activities to lessen cost of operation.